Okay, great. Everyone, we'll get started. So thank you for joining this webinar today. We're going to be talking all about startup structuring. Now, feel free to ask questions throughout this talk, and I will pause throughout the talk, and I'll endeavor to try and answer as many questions I possibly can. Okay, so today's topics. So what we're going to talk about is the importance of structuring to founders, why it's important, the timing of it, and obviously where you're going to choose to set up when you're structuring your startup. Where do you ultimately start? Because for some of you that might be on this call, you might be at a particular start of your journey as a founder, and you need to consider when do you start, in which order, how much should you be spending to get going. We'll go through options as well, particularly for the emerging markets. We're going to talk about process and timelines. We're going to touch on banking. So why is structuring important? I'm just going to briefly go through this slide. Just don't know where I started and stopped. But one of the things is that, right, it's really important for your investment to protect the startup. It can be a one-way choice, right? So making sure that you pick it wisely is important, because changing it later, even though these things do happen, usually happens much later and it's a lot more expensive and complicated, okay? So it's something that you, ideally, if you could pick a jurisdiction, be comfortable with it, it's going to put you in good stead as you move along. Depending on your choice, it can also limit your investors, and can increase your tax liability on an exit in certain jurisdictions. Okay, so we're going to touch on this a little bit as well. Structuring early is often a sign that the founders are serious about their startup, okay, because when you are structuring early and you structure it right, you're walking around talking to investors with confidence that you actually believe that you're going all the way. We often see this dilemma with founders, and this dilemma with founders is often a situation where they are obviously trying to be as lean as possible, save their cash, focus on other things, which is absolutely right. However, they're the same ones who are going to walk around looking at VCs and angels and saying, listen, I need $1 million at a very high valuation, but yet they haven't spent any energy or their own money structuring themselves like they're going to be successful, okay? And it usually is perceived that way when people are essentially, looks like they're hedging their bets a little. So what does a typical startup structure look like? Sorry if I have spoken already on this. So you're going to have that holding company, you're going to have that operating company. The holding company is usually in jurisdictions that specifically has a type of company that's only job is to hold assets, and assets include other companies. It could be property, it could be other tangible assets, but it's also intangible assets. So these intangible assets are things like intellectual property, which is ultimately what a startup looks to build. And when they build it, they're looking to commercialize it. So that IP sits there. Remember that when you're building a startup, the founders are the ones who has the idea. They've got the willpower to kind of take it all the way. But ultimately, the collection of everyone inside that company, all the employees, all the founders, everyone who's contributing, is contributing to the growth and then the ultimate commercialization of that IP. And that is where it sits there at the holding company. The other thing is in operating companies is as you grow, you start to have operating companies in different jurisdictions. And the key thing here is that sometimes you can open up in a country, you can set up an entity, and then you don't successfully take off in that country. So you then decide to wind up. But when you wind up that operating company, it doesn't affect any other part of your business, right? The founders have their shares, the investors are there, your employee share option plan with your team members sits up at the top as well. And then you sort of grow out. Your operating company is also ultimately where you're going to transact with customers. It's going to be where you have your employees, your consultants, right? You're going to get your revenue, you're going to have your costs sitting there. Your holding company remains passive in that particular space. It takes that investment in, passes it down to the operating company. Okay, so some of the structuring benefits of why you do it is, as you can imagine, when there's all these countries around the world, there are only a certain amount of jurisdictions which are deemed investable, right? And these ones I'll show you in a slide in a second. But the key is having this entity that means it's investable from day one. So any sophisticated investor, whether it's a VC or it could be an angel who regularly invests in startups, will know where these jurisdictions are. And when you present that you're in that particular jurisdiction, they'll know straight away that the terms they're signing on the agreement that they're having with you, whether it's using a convertible note or it's buying equity in your company, they'll know that they'll have their rights enforced if required. Often the jurisdictions that are picked, usually have favorable legal systems that help both founders and investors ensure that they'll be protected if something was to go wrong, particularly on some of these early stage startup agreements. Another key benefit is there's no foreign ownership restriction. So as you can imagine, in a lot of countries around the world, there are requirements to have foreign shareholders in companies. And so the last thing you would want to do is have an investment structure in one of those countries. So the idea is to push it one level up and make it easier for anyone from anywhere around the world to invest in your company. The other one, because it is a passive entity, which means it's not ultimately operating, it doesn't need office space, it's usually lower cost. And I know that can often be subjective depending on where you are around the world, but it is deemed a lower cost entity, particularly in places that are tax-free. Okay, so we've pulled together a list of 25 of these investable jurisdictions, and by no means is this every single entity, but what happens is when we speak to VCs or we speak to accelerator programs, they'll often say that, look, they've spent some energy going around and determining whether some of these options work for them. Now, you'll note that some of them are only relevant when they're investing in a program in a particular country. For example, it might be, Germany or Portugal or France. It's not where you would go and set up your holding company. However, it might be that a VC in France, for example, might invest in a French company. But for the rest of the world, the emerging markets, the most common ones, are obviously the UAE and Abu Dhabi Global Markets or DIFC, Cayman Islands or Delaware. They're the kind of entities, or Singapore, they're the kind of holding companies that are probably take up about 90% of what we would call the rest of the world when we look at holding company jurisdictions. So there's so many options. So what is right for you? Well, in this region, as I just touched on, the four main ones, which pretty much cover almost everyone that we see, is Abu Dhabi Global Market, Cayman Islands, Delaware, or the DIFC. And these are the jurisdictions which are most common. They're definitely accepted by the VCs in the region, and international investment from VCs has definitely come through into these jurisdictions. So these are the four main ones that people set up. Now, what is the right one for you? That depends. So just on pure cost, let's just talk about that. So in ADGM, you're looking at setting, it's going to cost you $3,295. For Cayman, it's going to cost you about $2,900. And for Delaware, it's $495. Now, if you were going to compare all of these options just on price, logically, you would say, well, Delaware seems like the great option for me. However, cost isn't the only thing that you should look at. In fact, if anything, it's probably misleading. So in terms of timing, they're all reasonably fast. They will all be able to have enforceability of the kind of venture capital kind of terms that you're going to be entering into, both with more established VCs as well as angel investors. All of them are accepted by the VCs. At Cayman Islands, for example, the vast majority of VCs, particularly outside of the US, are actually set up in Cayman. So they're very, very common. They're very much aware of that jurisdiction. In ADGM, for example, there's approximately 1,100 startups in the region, and one or two of the unicorns have also set up there. So there's been plenty of evidence to see large international VCs invest in ADGM. Key difference here, I think, across the three of them is that ADGM and Cayman are tax-free. And we're going to touch on this in a slide in a second. But Delaware, there was always a perception that it's tax-free, but in fact, it's not. And the reason why most people don't know about it is because A, most startups are not earning a profit, so therefore it's not an issue. But it's not profit tax we're talking about, it's capital gains tax, which we're going to touch on. So when I speak to a founder, particularly in the region, there is some logic as to where we recommend for you set up. So let me just go through some of this logic with you now. So if the company has 25% of either GCC national or a UAE resident ownership, we would say ADGM is a great option for you. The answer is no, but then ultimately we would ask, will you be setting up a company in the GCC, so the Gulf countries, in the next 6 months? The answer is yes. You're now, again, eligible for ADGM. If the answer is still no to that, the next question we would ask you is, are you or the majority founders a US citizen or resident? And if the answer is no, then we would recommend Cayman Islands. If it's yes, but then we say, are you going to be doing business in the US and transacting, or are you just using this as a holdco? And if the answer is no, it's back to Cayman. If the answer is yes, then Delaware is a good choice. Now, Delaware is a perfectly good choice for North American startups. In fact, it's used right up from Canada down to the South America for all different types of structures. However, the rest of the world, Delaware is not a great option. And the reason why historically people have always picked Delaware is either because you've just gone on price, or you've Googled it and just realized, well, the first page says Delaware, so that must be right. But you've got to remember that historically about 80% of the world's startups were in the US. So therefore, obviously the sites that are talking about Delaware were always going to be pushing onto the front page of Google. So that's why Delaware was always coming forward. But in the US, if I was in any other state in the US, Delaware is a fantastic choice. Whereas the rest of the world, you know, places like ADGM and Cayman are much better, particularly for ease of doing business. And obviously, one of the other benefits is no tax. So does tax matter for a startup? Well, obviously, tax in the more traditional way is I pay taxes on profits. And so no startup realistically pays any or has any profits. So therefore, you're not really worrying about that. But we're going to talk about the different types of taxes and one of the things that you should be looking for, and why I've just mentioned about maybe steering away from Delaware in certain circumstances. So there's personal income tax, so where you're deriving income, and that'll be wherever you live, right? So if you choose to live in Norway and want to pay 65 cents to the dollar, then that's a matter for you. But if you live in the UAE where there's zero tax, well, then again, you're paying zero tax. So that's personal income tax. Then there's company profit tax. Again, not a big issue. Places like UAE, for operating companies, there'll be tax, but again, it's for profits. So for startups, when you're just essentially churning money in order to grow fast, right? Again, it's not a big issue. Capital gains tax is something that happens at the end. And for most founders, you are building a business to try to sell. That's one of the key things you're doing. And although you might say, well, tax is tax, if you can avoid it and you're already in a low tax jurisdiction yourself, or you're planning to stay regional, it doesn't make much sense to just go to a country and volunteer capital gains tax to them if you have an exit. So that's one of the key reasons for you to look at that. So Delaware has a 21% capital gains tax on exit, which is linked to the federal tax system. There's a link here when we send the slides to you after this talk. You click on that link there, and it will tell you about a founder's story that costs them up to $100 million just as a result of being structured through Delaware when they didn't need to be. So when and where do you start? Okay, so most founders start their journey by getting together. They might be a single founder, or they find co-founders, and they sit around a table and they say, let's start this company. I believe we're onto something. And they'll inevitably go and set up an operating company in their local jurisdiction, which is perfectly fine. But the holding company should be set up when you're raising money, which, as you can imagine, when you set up a company, the first thing you do is you're looking to raise money, even if it's from friends and family. The other one is, as you start to take on your first employee, you're going to look to create an employee share option plan, start to promise them some equity in the business. So they're as motivated as you as a founder, making sure that you're all on the same page to grow this business and ultimately exit it for many, many millions of dollars. The other one is if you're registering IP. So intellectual property, ultimately, when you do register it, there's a lot of processes, particularly when you're registering it around the world, to make sure that it sits with the right entity, because that's the entity that one day when someone comes and says, I love what you're doing, I'd like to buy, they're going to do due diligence on that entity. So having it in the right place from day one is super important. The other one is formalizing a founders agreement, which we'll touch on a little bit later, but a founders agreement ultimately is how the founders interact with each other in the startup. And so think of it as a bit like a shareholders agreement for those of you that deal with this. And it's really important because the founders agreement has one very important provision in it that actually helps founders deal with founders dispute, and that's called reverse vesting, which means if I have two co-founders and we've all got an equal share in the business, but I decide after 12 months it's not for me, or you decide that I'm not for the startup and I leave, you don't want to have a situation where you're saying, can you give back your shares to me? This allows all parties to know that if something happens for any reason, that the shares have to be given back. And it's kind of the opposite to vesting. So for example, it might be in the first year that if I leave, I get nothing. If I leave in year 2, I get 20% of my shares and the rest have to go back to the company. So it's an important document. Again, the reason why I'm mentioning this and the importance of this at the holding company is, again, the holding company is going to be where those rights are most enforced or enforceable, right? It's usually linked to something that's going to allow you to run a matter if needed and actually succeed rather than relying on your local laws wherever they are. So when you start, you often need money to structure quickly, right? And cheap is always tempting. And we get a lot of people saying, why did you pick Delaware, for example? And they say, well, I saw Stripe Atlas, it was $4.95 and that might be fine, but that's usually the only consideration they did. But we always say to people that the whole idea when you set up a company is doing a budget, understanding what's it going to cost you to really get going. Now, I'm sure if I spoke to a founder who was thinking about setting up a company, they'll know how much the developer is going to cost. They'll know maybe, how much they're going to pay themselves or whether they need to hire someone, what that's going to cost. But they very rarely actually budget for what the costs of structuring. It's just one of those things that I guess they just assume it can't be that hard, can't be that expensive, everyone's doing it. So what we say to people is that you've got to kind of budget. If you want to do it properly, the first year should have about $20,000 to $25,000. Now you might be thinking that's quite a lot, but I've absorbed in that price, I've absorbed all ancillary transfer fees, any service fees you may decide to pay, anything that might include you getting structured right on day one. Now you might get plenty of change from that depending on where you set up. But the thing is that your worst case scenario is you've got the money knowing that when you raise and you say go and raise $250,000, you don't just leave yourself with nothing, because that's when founders start making wrong decisions. And I think that's one of the things that gets really frustrating as a lawyer, knowing that it's very easy to make a good decision and then you'll realize longer term, it'll never cause you any problems. In an ideal world, as founders, actually, when founders get together and they're saying, well, how much money am I going to put in on day one to get this going? We would recommend that the founders pay for that initial structure. It's coming back to my earlier point that I mentioned, which means that it actually shows some confidence in your ability to believe that your startup's going to succeed. There's always this concept as a founder that being a pure lean startup is the only way to go. And trust me, we all believe in that. But there are some things which I would call, they're essentially needs, not wants. And I think structuring is one of those needs. So your fastest and most cost-effective way, of course, is to form your company on Clara. If you haven't got on, feel free to do that because you can just go through the process really quickly. So we obviously speak to a lot of founders. We have a lot of founders on our platform. And one of the things that we've noticed, which is an interesting trend, is second-time founders come to us and they make decisions very quickly. And what most importantly is they set up their holding company first. And the key reason they do that is they know what it was like when they tried to do it the alternative. They knew that they set up the operating company. They waited 6 months to a year. Then they set up the holding company and they had to move documents across. They had to do all sorts of other stuff. So what they do is they come through and go, nope, I believe in what I'm doing. I'm setting up this holding company straight away. I'm going to get all those key legal documents signed. I'm going to issue those safe agreements straight to the investors immediately from the right company. And that's super fast. They sign the founders agreement if that's what they need to do, and then obviously create an employee share option plan. The one thing when you set up the holding company first is then the operating company location is less of an issue. You can literally set it up wherever you feel comfortable as founders. Maybe that's just where you want to operate, right? But when you don't do that, then your operating company sometimes does have some impact, particularly if you're trying to raise money on that operating company for some reason. The other one is setting up a bank account for both. And the reason they do that is because historically, because banking has been quite painful, which we'll touch on in a second, what happens is people will just go, well, I'm going to sign an agreement at this entity, the holding company level, but then I'm going to receive the funds in my operating company. And it might seem perfectly fine, but just remember that a successful startup, particularly when you get to a Series A and beyond, you're going to need to be audited. And as part of that audit, what it's going to mean is the more money that's floating in the wrong accounts and the wrong entities is going to mean your audit is going to be incredibly complicated, probably expensive, and it's going to require a lot of cleanup. So it's really helpful to make sure that if you are signing an agreement with an entity, that the funds flow through that entity as well. It makes life a lot easier as you move along. The other one is don't drag your structuring out. Ultimately, there are plenty of correct areas to set up a holding company. So there's not just one that's right for you. There's a lot. There's plenty of wrong places to set up. So that's the easy cut them out. But don't drag it out. Often people will drag it out. They're looking for the absolute. They're looking for some sign from above that says that's the place you need to set up. And as long as you get good advice, you'll feel very comfortable to make that decision. Know that a lot of other founders have come before you. You're not the first founder to ever be a founder of a startup. And so if you go down that path, you do it very quickly, it does help you. And ultimately, second-time founders will come in, they'll have everything done in a month or 2 months maximum. And then they can move on and build the product or the company they've always wanted to do. So some of the operating company considerations when you're structuring, and just to note this, is ultimately where is it going to be located, and do you have access to staff? All right, is it the right place? And even in countries like the UAE, it can be, are staff going to come to your office? Is it too far out? Is it not on a metro line? Is it somewhere it's too expensive? So that's really important to consider as well. The other one's office space. In certain parts of the world, and including the UAE, right, as things sort of get super busy, often office space is really hard to find. And if office space is hard to find or it's super expensive, then ultimately that's going to put pressure on you, and then you have to decide whether to move your company entirely. The other one is ecosystem. So for example, there's plenty of places that you can go and set up, and some might be a little bit more expensive, but the ecosystem is very, very good, which means that the regulator or whoever sets it up ensures that, VCs are wandering around and doing talks, and startups have opportunities to run seminars, all sorts of different benefits, and being in the right place where you're rubbing shoulders with other founders who are going to motivate you and share in information. The other one is expansion costs. So that includes things like visa costs. We talked about office space, and just knowing that if you do go really well and you're wildly successful and you go from, say, 5 people to 50 or 70 people, what's that cost going to look like? Some startups know they're going to be people heavy, right? They might be very operational. And as a result of that, knowing that you can be somewhere where you can get enough space to both issue the visas, for example, and to put enough people in that office is important. So there's some of the key considerations when picking an operating company. So often what happens is people sometimes come to me and say, look, I get it. I want a holdco. I'm not raising money. I just want to spend some time getting going, and then I'll make a decision in 6 months to 12 months. And that's perfectly fine. And that happens quite a lot. So then obviously they're going to have to set up a entity. And when they set that entity up, they're probably going to do certain level of legal actions because it's just inevitable. They're probably going to raise some small amount of money from someone. And they're going to probably sign some kind of documents with, particularly, obviously, their employees or consultants, but they might then sign a founders agreement with their founders, given it's the operating company. So there are 2 common law free zones in the UAE, for example, and that's called ADGM and DIFC. And those two free zones allow you to, they have the same benefits of the holding company, even at the operating company level. Now, you can go off and you could, in theory, issue safe notes, and it can be governed by the law or English law or ADGM or DIFC law, and they can be converted if required. Obviously not recommended, but the point being is the documents that you're signing with these entities do work. Now, that is really important to remember because there's plenty of options for operating companies. However, doing any documents with those entities can sometimes come back to bite you because they just don't work. And it's going to require you to spend more money on lawyers to try and clean it up when you do actually structure a holding company. However, the way that we recommend, if you were going to do this, if you've got a tech license or an innovation license, is set it up, then go and maybe sign 1 or 2 safe notes, get some money, and use that money to then go and get your holding company. And that might take, might happen in 3 or 6 months from setting up the tech license, if that's what you want to do. However, just remember that one of the pitfalls of doing this is the more you wait until you set up your holding company, the more documents you're going to sign with the entity that's not the one that you're going to need to stay long term. So if you went off and signed 10 safe notes, founders agreement, even went off and created an ESOP on that entity, it might seem all fine and look great, but the reality is that somewhere along the line, a VC is going to say, that's all great. Can you go and set up your holdco? And I need all of that cleaned up, which means you need to go and terminate those agreements or novate them and push them up to another entity. Now, for any of you guys who know what it's like chasing up founders or chasing up investors for signatures, the last thing you want to do is later on make them sign the agreement another time, right? So it's not always as ideal to do it this way, but I just wanted to mention it because it does happen. So so we've touched on this on the legal documents. So the key one is the more legal documents you sign with the wrong entity, although it works legally, the more effort it's going to be for you to clean up later. So again, coming back to the earlier slide around tips that second-time founders recommend, what do they recommend? Well, set the holding company up on day 1, right? Get everything signed correctly from that entity. It's going to save you a lot of time. And that's why they do it, because they've gone through this before, because they tried to save, a couple of $1,000, $3,000. The other thing to note as well is that you often think you're saving some money, but if you go to a lot of these regulators and you say, oh, look, I'm the single founder of this DIFC or ADGM tech company, and now I want to do a transfer to have the holdco own this entity, they can often charge $1,000 to $1,500 just to do that transfer. And that's assuming, again, you're doing it yourself. So all of a sudden you've saved some money, but when you really look at it, it's not that much you've saved in any particular year. So just so you know, if you are considering operating companies, we've got a guide on our website. So go onto our website and download the UAE Startup Guide. It includes ADGM and DIFC, but also it includes a lot of other free zones and regulators in the UAE, if that's of interest to you, but it's all there. So what other costs do you need to factor in when you're structuring? And this is a key one because, often when you go onto any website, you'll often see headline prices, this is how much it costs. And that's all fine, but let's face it, there is a lot of other moving parts when you're combining a structure. One of the ones is particularly when you're in different countries to where your holding company is. So for example, you have a Saudi operating company and an ADGM holdco or a Cayman holdco. There's a concept of notarization, legalization of documents. This, can I say to you, is one of the more painful things that you'll ever have to do because it's a waste of money. And, historically, it was essentially a way for a notary, so a lawyer, who says, I confirm this document is a true document that came from the ADGM registry. Legalization is the process of taking that notarized document to a ministry and saying, hi, can you confirm that the notary is real and that the document therefore has the right stamp on it, and then they confirm it. What happens? That happens inside a country, and then they fly those documents to another country, such as Saudi, and they then go to the Ministry of Foreign Affairs, and they'll have to go through the embassy in Saudi and Abu Dhabi. So this process, by the way, is something that can cost sometimes anywhere between $3,000 to $5,500. So it's something that you just need to be aware that it is a process that you have to do. You have to do it once. You want to connect the entity. So the key, obviously, is to get it done and connect the entity at the operating level as quickly as you can so that you don't have to worry about doing that again at any other time. The other one is the things that often happens from operating company regulators or banks, such as they'll ask for a thing called a certificate of incumbency or something similar. So it might be a register of members. This is a document where they just want to know that who are the shareholders and what percentage ownership do they have and who are the directors. And this document is not something that necessarily comes automatic with the establishment of the entity, and often requires things like an ADGM to stamp it or Cayman notary to stamp it. Often they'll want an additional stamp, which again can cost money. So just be wary of that. The other one is you often set up, and there's always a misleading understanding that when you see a company saying, this company includes 3 visas, you think, great, now I'm ready to get my visas. What it means when it says it includes 3 visas is it means that the office space you've acquired as part of the package includes 3 spots for visas. It doesn't mean your visas are included in the price. So in order to do that, you have to then go pay additional money to get the visas, and you'll often need a concept of a corporate establishment card, at least in the UAE. So it's another document, it's another fee. The other one is a bank account minimum account balances. Okay, when you set up a lot of accounts, not always, but some of them might require anywhere between $500 to $5,000 as a minimum requirement. So keep that in mind as well, so that you've got that money put aside. And obviously, with all of these bits and pieces, unless you're comfortable or know what you're doing, you'll often use a service provider to do these things, and there'll be some additional fees for them to do some of this for you. So just keep this in mind, because these are the key things that often are additional costs on top of actually setting up the entity. So how long does it all take? Well, the time of setup often is quoted based on the lodgement with the regulator. So one of the key things that we notice is why things take so long is actually not from the lodgement date. It's very rare. Usually we know a guide anywhere between, say, a couple of days to 10 days, worst case scenario. But it's often when the founders start the process, like, well, it's a company. I know, my name, here's my passport, let's go. And then they'll realize maybe some of their investors they've added, maybe some of the founders don't have the right documents. And it's that process that slows them down. It might be that you've put the documents up, but as a result of a particular passport type you have or something that's come up, you're asked for additional information. And that's the kind of stuff that slows down. So my recommendation always is, if you really are trying to set up an entity for investors, get started as soon as possible, because you just never know until you've started the process. So when we talk about this KYC, this extra information, this is very common and something you're just going to have to get used to as founders. It's called Know Your Client. And this is something that's become increasingly more onerous, particularly in places like UAE and Cayman, because they're being put on the grey list for Financial Action Task Force. Now, it's not bad. It just means the grey list essentially just means that, look, guys, you need to pick up your act. You need to ask for more information. So that's what comes down from the federal government. And then every regulator and regulated entity that serves that regulator, such as ourselves, are required to ask additional questions based on rules they've set for us. So just be wary that when you're doing any of this, and it's not just setting up your company, it's also for banking, that you do need to have these documents. And sometimes, depending on what happens, you might be asked for information which can seem a little bit intrusive, such as bank statements or something else that might be that you may not feel comfortable giving, but it's something that's required. So just bear in mind, obviously be patient and don't blame the messenger. But it is something that for a lot of founders, maybe the only KYC they've ever done was setting up a bank account 10 years earlier. And so it comes as a bit of a shock to them. So what are the key legal documents? So you've set up your holding company in an ideal world and you've got your operating company. So those key legal documents that you're going to set up, you're going to go and get your founder's agreement if you've got more than one founder, of course, right? So that document is going to be generated. The next thing is, as a collective, even if it's just a bunch of you to start with, including your developer, even if they're external, is getting an IP assignment agreement signed by everyone. And you always might be thinking, but why do I need everyone to sign? What about if I've got someone who sits at reception, they're not generating any IP? And you're absolutely right. But what is good practice is a document that's reasonably standard should be signed by everyone, because it makes then due diligence later when someone's looking to acquire you or invest in you to go and say, look, we've seen you've got 50 employees. We've also seen that everyone has signed this agreement. So we don't have to drill down into that person's role and whether or not they do or do not create IP. The other was in share incentive plan. Just one thing with the share incentive plan, just because you've created it doesn't mean the shares have disappeared. Sometimes it's just creating it so it's on your cap table. Investors will expect it, particularly VCs. They'll want to see that you have allocated shares, obviously from the founders to future employees. But just because you've done it does not mean that 10% has gone off your cap table. It just sits there ready to be allocated as and when you grow. The other one obviously is safe notes. Try to avoid, everyone, if you are setting up, try to avoid selling equity early on, right? It might seem like a great idea. It might be great that you're talking to your uncle and your uncle says, I love what you're doing. I'm going to give you $100,000 for 10%. Even though that sounds really exciting, it's a really, really bad idea. And largely because you don't know what the valuation of your business is. It's way too early. And when you take equity, there are a lot more legal steps that are required in order to do it, right? They need to be added to the cap table. They need to sign subscription agreements. They might have voting shares, which means you need a shareholders agreement. And all of this, just for that $100,000, creates almost an unnecessary Series A, essentially, which means a lawyer that will speak to you will go, well, doesn't matter whether you raised $100,000 or $5 million, it's going to be about the same amount of legal work. So just try to think about that for giving away equity if you can avoid it. The other one is restricted covenants for founders. Okay, just making sure that the founders, if they were to leave, that they're not going to go off and compete with the idea in the business. And if the founders are taking a salary, the founder service agreement is just a document that says, hey, I'm a founder, I'm working full-time on the business, here is my particular job, and this is how much these are the particular roles I'm going to do. So that is also, the founder service agreement is also a document that even if you're a single founder, you would be expected to sign. Banking, guys, I know for any of you who have dealt with banks, it is painful. And it's something that at Clara, we are constantly working on to ensure that that we can find solutions for you. But it's broken for startups. It started to get a lot better, obviously, in places like the US, Singapore, and UK, where more digital neobanks were established and they were a little bit more relaxed, which was fantastic. So there was a trend. The rest of the world, it was really difficult. Key reasons why banking is so problematic, when we've gone off and spoken to banks, it's largely compliance, right? They don't like the fact that a startup can get millions of dollars from lots of different people at any particular time. It worries them, right? Because it triggers all sorts of alerts in their system. It also means that, obviously startups fail, which means they're going to have to do a lot more closure of bank accounts, but they make no money from that. And also the other thing for a lot of banks is they're looking for both large deposits, but they're also looking to be able to upsell things like, company loans, which they're never going to give a startup. So they're the kind of reasons why most traditional banks don't look to set up accounts for startups, which is quite painful. So what are your options? Well, look, in the UAE, there is the right intention and things are moving in the right direction, but it's definitely still quite painful. So there are a couple of neobanks, one called WEO and one called Zand. They have the right intention to set up. Zand is probably not looking for startups necessarily. WEO are looking for startups. However, their compliance requirements change regularly, which is always hard to track. The more traditional banks that might set up is like Emirates NBD and Mashreq. Again, you're going to physically need to be there to sign physical forms, right? It's for a tech startup and a tech founder, the last thing you want to do is go through that very backward paper filling out, which happens with traditional banks. In the US, Cayman, and Singapore, it's definitely better for sure. So you've got great banks like Mercury Bank, Aspire Bank, and Arrival Bank. These are banks that are making real inroads. They're really taking up the weight of what happened after Silicon Valley Bank and Signature Bank collapsed. So they're really trying to take up a lot of that market share, particularly in more of these emerging market or holding company jurisdictions. Speed of setup can vary. Sometimes you can be super lucky and go and set up a bank account in a couple of weeks, you've got it. Other times it can drag out and it really just depends. So Again, Clara, we're constantly focusing on this to find solutions, but just be wary that it's one of those things that you just have to be patient and work with what you've got at any one time. Just some common structuring myths. We're almost finished, guys. Global investors won't invest into ADGM. That's completely and utterly wrong. There are plenty of large VCs that have set up and invested in ADGM, including, some of the unicorns that have set up in ADGM have had some of the largest VCs in the world put money through that structure. So that has obviously been proven. European VCs will not invest in Cayman. All right. Sometimes there is some truth into that. However, it's not true. If you're a company that is amazing and you're structured that way, generally most European VCs may not like it as their first choice, but they will definitely invest in it. It's just the reason for the background for that is Europe just tries to go very straight 180 and would prefer not to invest in anything that might be on a grey list, because it just means they have to then do additional KYC from their bank. But again, it's not a absolute carte blanche how that works. Convertible notes, like a safe note, works with all opcos. I touched on this earlier. It just doesn't. The reason why most people think this is true is because you can sign any piece of paper, and if someone signs it and gives you money, well, that's great, but it doesn't work. And the reason is most people don't actually know the story of what actually happens when someone picks up that document and says, hey, these guys are failing, I want to convert. And then they try to talk to a lawyer and say, can I convert on a Dubai Silic or an Oasis entity or a Saudi opco, right? It just doesn't work. Delaware is tax-free. We all know that. I've spoken about that, obviously. Moving IP from a taxable jurisdiction later. This is another problem that we're seeing with some of the startups. What they're doing is they're going, well, I'm going to set up in somewhere like India and I'm going to generate 2 years of IP. And then what I'm going to do is when I feel like I'm going to raise money, I'm going to go set up a holdco and I'm going to move the IP. Now, this happens also in other places like Ireland and anywhere where a country has tax, they will deem that an exit, all right? It will be deemed a capital gains because there will be value, particularly if you've raised money from that entity. So just be careful on that one, because once you've done that dash, it's very, very hard and requires a very expensive tax advice to get you restructured. The other one is, I'll clean up my structure at Series A. I'm just going to go with an opco forever until my Series A. Well, perhaps that might be the intention, but the reality is that you won't be able to get your ESOP in place. You probably won't be able to fundraise. And if money starts to dry out, or like we currently are seeing where the VC market is tougher, you can't be rapidly and constantly investable, which means if someone wants to offer you money, they're just not going to give you money very quickly. You're going to have to go off and structure yourself. And delay often means you've lost the money. So that's really a bad idea. Don't need a bank account at my holding company level. Again, we spoke about this earlier around good auditing, good accounting practices. Try to have your money in the right entity. Only US VCs invest in Delaware. Completely wrong. That's not the case. Just to give an example, if you look at Y Combinator, right, Cayman Islands is one of those jurisdictions in which they accept. Okay, and so they're one of the largest sort of big programs in the US. So that's just an example. Just to recap, guys, last slide here, structural recap. This is what it looks like. This is your ultimate structure, okay? So you're going to have an operating company at least to start with. You might have multiple operating companies in different countries. You're going to have your holding company. And obviously, in an ideal situation, if you're going to be signing safe agreements, you're going to get your ESOP, get that holding company set up. So the IP will sit there. You'll have your founders agreement sitting there all at that top level, and then the operating company can move. So for example, when I told you earlier about some of the restrictions on an operating company, you might find that the first 4 years you set up, you're in a particular jurisdiction, but you decide, hey, we're going so well, I need 100 people now. You might move that operating company to a different jurisdiction just to handle that inflow of employees and consultants. As a result of it, the holding company stays the same. So it makes that option a lot easier. So anyway, that's the key way that every startup should structure. Any questions, guys? Thanks again for joining. I know there was a lot of content there. Thanks for looking at my talking head, everyone's worst nightmare. So everyone, conscious, conscious that I'll send through the slides after this, probably tonight or tomorrow. And if there's any questions, please feel free to reach out to us at Clara. Look forward to helping you out on an individual level. And if you haven't logged on to Clara, please do. It's completely free to try it out. If no one has any questions, I'll end the session. Oh, actually, sorry, I just realized I've got Q&A, a million questions. Yes, my webinar has been recorded. Thanks for everyone telling me about losing the sound. Sorry about that. There's just one of the, do you recommend a startup advisors to be under opco or holding? It's always the holding, guys, because ultimately most advisors will take equity. The tax point for Mohammed, that you'll probably need to get tax advice, but just note that there was an announcement about under 3 million dirhams for the first 2 years, you don't get taxed, so that could be helpful for startups. That's a good point, Wesley. Wesley rightly pointed out that one of the things is that when you're adding new shareholders, there are a lot of additional costs, obviously, when you're adding more and more shareholders. So that's one of the things that you should consider as you, why you're using safe notes, obviously, but it will be an additional cost when you're setting up. Visa allocations the way, yep, you're right. So Wesley rightly pointed out that the visa allocation is something that's quite misleading in the market, and we agree. And it's something that often is linked to the office space. So for example, in DIFC, a $500 lease gets you 4 visas, whereas in $500 lease in say ADGM would get you 3 visas. Now, when we say gets you 3 visas, it means you're entitled to get 3 visas issued by the regulator. Okay, and it is being recorded. So if there's anything else, yeah, please reach out to me. Thanks, everyone.